Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today, we're diving into Princeton Capital Corporation's latest financial filing. Let's just say it's a bit of a Princeton mess. They had to refile their report after discovering some accounting errors. So buckle up because this could be a bumpy ride. Princeton Capital, as they tell us, is in the business of lending to smaller companies, hoping to make money off the interest and potentially some stock gains. But things haven't been so smooth lately. They're currently weighing their options, including a possible sale of the company, a merger, or even just calling it quits and selling off everything. Not exactly a sign of booming confidence. First up, let's talk about why this whole amended filing exists. It seems there were some, shall we say, oopsies in how they summarized the financial info for one of their holdings, Advanti's Certified Staffing Solutions. Specifically with what was reported on Advanti's balance sheet and income statement. Apparently, they forgot to write off a bad debt, miscalculated some liabilities, and even included some transactions that shouldn't have been there in the first place. Intercompany transactions should be eliminated in a consolidated presentation. It's like someone trying to bake a cake but forgetting the flour. Princeton Capital admits the errors came from a material weakness in their financial reporting controls. This is corporate speak for we messed up and our internal systems weren't good enough to catch it. This isn't a great look and often makes investors nervous. Now let's peek into Item 7, where management discusses their financial performance. It is restated as a result of the need to correct the financial information in Note 10. They're very upfront about the fact that a bunch of what they're saying is forward-looking. In other words, this is management's best-case scenario, which they might not even achieve. One of the biggest things to keep in mind is that strategic alternatives review I mentioned earlier. They initiated it way back in 2019 and it's still ongoing. That's a long time to be considering options, and it suggests that they may be struggling to find the right path forward. It kind of overshadows everything else that's going on. Let's peek at the financials. At the end of 2023, they had investments in just 5 companies, a tiny portfolio. Their investments were worth roughly $30 million, and the weighted average yield on those investments was nearly 12%. Not bad, but it does come with risk, as they discuss later. They say they only book interest that they think they can actually collect. As of the end of last year, they had 3 loans where they weren't even accruing interest. These loans are considered troubled, and their poor performance has a domino effect on the company's financials. On the expense side, their operating costs decreased compared to the previous year, mainly because of lower legal and audit fees. This is a good sign, but remember, it's also because they're not actively making new deals. The savings likely result from the strategic alternatives process and are a sign of reduced activity, not necessarily better efficiency. Their net investment income after taxes flipped from a loss the previous year to a profit. That's definitely something to celebrate. However, this was almost completely offset by losses elsewhere. It sounds like a big deal, but is far more nuanced. Now on to Item 1A, the risk factors. This is where companies list all the things that could go wrong, and Princeton Capital has a laundry list. One of the big ones is that they are a non-diversified investment company. In plain English, this means they don't spread their investments across a wide range of companies, which amplifies potential gains but also magnifies risks. They also admit that their stock trades on the over-the-counter pink market, which is basically the stock market's bargain bin. They go on to say that broker-dealers avoid trading in these stocks because they're more volatile and high risk. This is probably why you haven't heard of this company. As with pretty much every business on Earth, Princeton Capital is subject to the ongoing impacts of the COVID-19 pandemic as well as cybersecurity threats. To that point, Princeton Capital acknowledges it relies on other companies, including their investment advisor. In a world first we're seeing these days, the report specifically addresses cybersecurity risks and processes for managing threats. Their board of directors is tasked with strategic oversight, and they get regular briefings from the chief compliance officer. The report lists a number of other risk factors to consider, including being unable to influence their portfolio companies to make decisions the company likes. But another big risk factor is the penny stock classification. This is really bad, so you should probably listen to the actual words the company had written. The market for penny stocks has suffered in recent years from patterns of fraud and abuse. Those words came directly from the SEC. The report has a section on cybersecurity. The board receives updates on risks, oversees the processes, and assesses the potential impacts. The company's management, including the company's CCO, manages the company's cybersecurity program under the supervision of the company's audit committee. Now that we've digested all the information, let's step back and see what it all means. Princeton Capital is clearly in a difficult position. While their high-yield portfolio is attractive on paper, it comes with significant risks, and this is showing in a number of ways. The biggest red flag is the strategic review process that has dragged on for years. This suggests a lack of clear direction and a potential struggle to find a viable path forward. There are things to like. Lower expenses, a move from losses to profits. But the fact that they had to refile their report to fix some rather basic accounting errors raises questions about internal controls. Their concentrated illiquid portfolio and penny stock status all add to the risk profile. Princeton Capital presents a very speculative investment. It might hold some potential for aggressive investors, but it requires serious due diligence, given the elevated risks, and an understanding of how they can correct their internal problems. Thanks for watching. If you found this breakdown helpful, please give us a like, leave a comment, and subscribe for more corporate decodes.